Hi, welcome to UOB Kay CIO Series number 30. Today we'll be sharing our official outlook for 2026. My name is Chi Wong, CIO of Private Wealth Management at UOB Kay. I'll be your speaker today. 2026, 2027, or even longer, we are looking at three disruptive forces for the very long term. And these will be permanent topics for us, and they will continue to change and influence the market as we head into 2026, being the U.S.-China relations, de-dollarization, and AI. And as I said before, when you look at these three forces, whether it's in 2026 or beyond, we are looking at possibly continuing challenging U.S.-China relations, and we expect de-dollarization to continue next year and beyond. And for AI, it's very important to note that we expect a temporary slowdown in AI capex. So there might be some cloud gathering over the AI industry. We've talked in details already before. And this leads to my number one prediction for 2026, which is exactly what I just said earlier. The AI capex is expected to slow, and that will have a major impact on the U.S. economy and the entire AI supply chain. We're not expecting a negative growth, but the growth will slow from something like 50% to 25 to 30%. Regardless, it's not going to be another 50 or 55% growth again in 2026. Nothing goes up forever. And this doesn't mean that we give up on AI or big tech. My recommendation is really to stay invested, but be aware of this slowing growth in AI capex, and watch and control the risk accordingly. And also, it will be good time to add some defensives, which I will talk about in a second. Number two prediction, my view that the Hong Kong China markets will continue to be limited by a sluggish economic recovery. As you recall, my number one prediction for 2025 was better than expected Chinese economic growth, which it did happen in the first half of this year. But looking forward to 2026, I don't think we are going to be that optimistic. Reason being that, especially in the second half, we are seeing continuous slowdown or continuing challenges in the real estate market and a slowdown in exports. Both factors will continue to weigh on the Chinese economy, and we're ready to change our view anytime from cautiously optimistic on China to cautious if the economy remains sluggish into 2026. So stay tuned. We will watch very closely the macro data out of China in the new year and ready to adjust. Number three, I said earlier, the U.S.-China relations will not get better. Will not get better in 2026 and will not improve over the long term either. And main reason being that U.S. is heading to the midterm election, and despite the truce between Xi Jinping and President Trump on trade matters, there are many other competitions and conflicts between U.S. and China. And what we are seeing right now when we talk about U.S.-China issues is increasingly about AI. So think about the timeline. In the beginning, it was about trade. Since the 2018, it turns into something about technology. And within technology, the U.S.-China rivalry is centers on AI. And that will be a very big topic in 2026 and also present opportunities as well as risks. So my advice is really not to take any sides here, but we need to be positioned in both U.S. and China AI stocks, because both U.S. and China each have their own advantages in AI. And this is something we discovered in 2025, that China may not be that behind in the U.S. in terms of AI, and especially in edge AI, AI devices, and consumer AI apps, China has many advantages. So another reason we need to look at both U.S. and China AI stocks. De-dollarization will continue. We talk a lot about de-dollarization since the beginning of this year. We've been right on about this, but there are also a lot of misinterpretations, which I will explain in a second. We view the safe haven currencies like Singapore dollar and gold as long-term beneficiaries. But don't forget, RMB is also a potential beneficiary of this trend. And we're seeing RMB appreciating significantly in the last few months since we talk about de-dollarization. And RMB, as you know, has over the past few years have been a undervalued currency. So now we're just getting back to normal levels. So I'm positive on RMB for the long term, positive on gold. But like I said, 2026 not going to be easy. The title of today's presentation already suggested the year of the white horse, suggests that it's not going to be a peaceful year. So prepare for volatility. Even in assets like gold, there may be some volatility. So brace for that. And lastly, here's something that we think differently from most of the views out there, which is people are optimistic about the December rate cut by the Fed and optimistic about a new Fed chair to replace Powell. This new candidate coming from the White House and the Trump-friendly, very dovish, and seems all good from here. But I don't think it's necessarily good news for the market. We just don't know. I don't think it's bad news necessarily, but we just don't know, because Wall Street has consistently miscalculated the Fed in the past. I'm not sure you guys remember higher for longer, which was wrong, and the 6 rate cuts for this year was also a bad prediction. So most of the street predictions for the Fed has been wrong. So now we'll not be surprised if we are wrong again. So be cautious there. And my advice for bond investing to stick to more short to medium term bonds, top rated bonds, to stay in the safe zone, to avoid as much as possible this Fed uncertainty. There's a lot of words in the previous table, so it's not always easy to present, but here's a visual aid to help you understand my 5 predictions. I talk about the great AI cool down, the capex slowdown. China will have the growth issues, the GDP, the economic backdrop remains weak and sluggish. That will cap the stock market upside. I call it the China's growing pains in 2026. I mentioned the U.S.-China AI arms race. The U.S.-China competition essentially becomes an AI competition now. And then de-dollarization, I'll call that breaking the dollar's grip. That was also the title of our CIO series way back on this. And the Fed wildcard to show the Fed uncertainty exists and continues into 2026. Hopefully it will be helpful to you and your clients to understand these 5 predictions. So if you want to summarize this in one word for 2026, it's defense. I'm not sure you remember, in September 2024, when everyone's so bearish on China, we had this CIO series on how to pick defensive stock. And the word we use called true defensive framework. And here's a replay. It's an ROIC-based framework to help you screen and select true defensive stock. And that will be very essential again in 2026 as part of our barbell strategy. Let me talk about the barbell again. You've probably seen this before. The barbell strategy, you invest in very risky, high growth, high volatility stocks. like AI and M7. On the other hand, you also need to be positioned in defensives. And I think back to 2026 outlook, I think this is the year to be defensive and the year to shift more towards the defensive end of our barbell strategy. Again, not to sell everything in AI or M7, but you need to have both and you need to weigh more towards defensives. What are the defensives in our portfolio? So here are some of the core recommendations. Berkshire Hathaway, Walmart did very well this year and last year. P&G, which we just added to our core recommendation last week. In China, we have China Mobile, we have PetroChina, and there's actually a basket of stocks that behave like China Mobile. They pay dividends like China Mobile. Bosera has something called Central SOE High Dividend ETF 3437. It's our trading buy. You can see the top 10 holdings here. If you don't want to own single stocks, this would be a good way to have a basket of what I call defensive stocks in Hong Kong. Well capitalized, strong balance sheet, strong cash flow, dividend payouts. That will be, continuous theme in 2026. A good place to be in 2026 amid all the uncertainty and market volatilities. And the most common question is, where do I see gold going? Do we have a price target for gold? The answer is no. Okay, but it doesn't mean that gold will go up forever and continuously and no drawdown, no look backs. Right? In fact, if you look at 2025, gold has also experienced some volatility. And I expect this volatility to continue. And the drawdowns could be very common in gold. So when you invest in gold, mentally prepare for drawdowns. It happens. But eventually it will go back up. Okay, so how to deal with this volatility? We have some resistance support levels here for you to consider. For example, 4,500 might be a resistance level, and 3,750 is another support level. 3,400 is the level where the gold will breaks the current bullish trend. Okay, so that is a critical level, apart from the support and resistance, which are more short-term levels. 3,400 is critical. I don't think gold will go back to 3,400. But in any event, if it goes to 3,400, that means must be some fundamental shifts, some big changes happen. Technically speaking, if it's just a random walk, I don't think gold will go back to 3,400. It will fluctuate between these levels, but not 3,400. Okay. And talking about gold, inevitably we have to talk about Bitcoin. There's a lot of similarity between these two asset classes. Bitcoin has gone through a lot of volatility recently, and there's a lot of fear in the market. I think the drawdown is more than 30% now. But here's my point. I think Bitcoin is here to stay. Here's a table that showed you that Bitcoin has gone through more than 50% drawdowns numerous times, and multiple scams and frauds and all kinds of bad news. But Bitcoin never went away. Just to help you understand how special this is, if Wang Qi, me as a CIO, said one thing that's wrong or made one mistake, you probably stop listening to me or believing me. Right? Only one thing. But Bitcoin's gone through numerous occasions like this. Bad news or these negative events, and it's still here to stay. So I think Bitcoin will be around for a long time. The key is how much it's really worth. I don't know. Nobody knows. There's no fundamental framework or methods to really evaluate how much this is going to worth. But regardless, it is here to stay, and it is a beneficiary of de-dollarization. The difference is that gold has been around for 40,000 years. going back to our cave days. When the humans started to emerge, we already started using gold. But Bitcoin's only been around for 16 years. So that is the difference. The gold has been around for much longer. And the key takeaway here is that if you like Bitcoin, there's no reason you shouldn't own gold. The logic is roughly the same, and gold is being around for a much longer time. Number two is that we are seeing possibly slowing adoption for Bitcoin, especially in developed markets. Here's some numbers that almost 30% of U.S. people already own Bitcoins. And if you ask around, especially in our business, almost everyone knows about Bitcoin, and most of people already have bought Bitcoins or Bitcoin ETFs. So that's not a small number. I said earlier, it's only 16 years of history, but over these 16 years, the adoption has grown exponentially. So the base is no longer low. Of course, there's still more growth in emerging markets, but developed markets, we're pretty much up there. And then the threat from stable coins as a transaction tool that will reduce the usage of Bitcoin as a payment system. And this is really important. I'll talk about it in a second, why this is so important. If Bitcoin suddenly becoming just a store of value, which is kind of now like gold, less than as a currency, okay? And then number four is, this happens every time. You have lower prices, lower expectation, lower interest, lower trading volume, and lower security budgets. And this gets a bit technical, which is once the chain, the blockchain that the Bitcoin sits on is maintained by the Bitcoin miners. The Bitcoin miners pay in two ways. One is mining Bitcoins in blocks, they call rewards, and they also get paid as a part of the transaction fee of maintaining the ledger, the blockchain, right? When there's lower transaction, which is the case now, as the prices drop, I think here's the headline saying that the November volume has fallen to a record low. When you have lower volume, means there's lower pay for the miners and the lower incentive for the miners to maintain. There will be less miners. So that's a challenge. That means it will become less secured as a cryptocurrency. And like I said earlier, if a Bitcoin just becomes a store of value, people just buy it and hold it, not trading it. It also causes the same thing. You have lower volume, lower security budget, and lower security levels. And then some people will say, well, Chi, you're wrong. Actually, we're seeing more derivatives trading. We're more ETFs trading Bitcoins. And sorry to say this, those trading, you're right, those tradings are going up. But those tradings, the miners don't get paid by those trading of Bitcoin derivatives or Bitcoin products. There's no revenue for the miners. The miners, again, only get from the revenue from the volume, only the volume, the underlying Bitcoin itself. When the underlying volume goes down, there'll be less incentive for the miners. There are more security concerns. So that is a big deal. And let's watch that closely if you're interested in Bitcoin. And lastly, of course, quantum computing, which will likely break the signature, the private address of Bitcoin, a major security concern. Some say that's only the beginning of quantum computing. We're years away from quantum computing able to conquer the security of Bitcoin. But I would say, these things always move faster than expected. This is not a short-term thing. It's a long-term threat, but also a threat that need to be monitored closely. Question on global index moving higher, Hong Kong, China, Asia, yes. China, Asia has underperformed this year. So this question on my view about Hong Kong index and China index 2026. My view was very clear earlier. The upside will be capped by the lack of real economic recovery in China. Okay, so real side. So again, going back to Hong Kong market, we talked about this in previous webinar as well. I call this the multiverse rally. Why the multiverse analogy is because you almost two worlds in the Hong Kong market today. The index is up a lot, but only a few sectors. I would say only 3 sectors did well this year. Most sectors did not outperform the market. Why? Because the economy is not improving, right? Technology outperformed because tech is strong, AI is strong. Healthcare outperformed because there's healthcare, they're gaining contracts overseas and they do more out licensing deals. And then the banks are relatively strong because the capital injection, all these things. But the rest, like real estate and did not perform that well. So that's the challenge. That will remain a challenge in 2026. When the majority of the Hong Kong sectors and the economy not improving, then the index will be capped. And that's the same issue with China A-share, okay? So China A-share, the difference between China A-share and Hong Kong today is Hong Kong is actually more weighted towards new economy and internet and AI and innovation and healthcare, biotech, right? But if you look at A-share, it's still heavily weighted towards the old economy. So as China's traditional economy is not improving as much, you have limited improvement in the limited growth in the China A-share. That's the fundamental reason. And again, that will continue into 2026. I don't see, last year my prediction is that 2025 will see upside in Chinese economy. Next year, I don't think so. So I'm cautious on Chinese economy. I'm cautiously optimistic on Hong Kong market. And Hong Kong market upside will be capped by, because of lack of this real economic growth in China will continue to weigh on the Hong Kong index and China A-share as well.